Just under 1 year ago, I did a video on Dubber titled Disaster Story. Now, a few things not to like about this company back then. And I've decided to do another video on this company because they released their Appendix 4C on July the 21st. And immediately they went into a trading halt to do a capital raising. So I've decided to do a video on Dubber just to see how they are progressing. And based off what I have seen, I have titled this video Disaster Story Part 2, sort of like the sequel to the previous video I did on that company. Now, you might be thinking right now that there is no way that I would take a position in this company. That's not the way I look at it. Even a disaster story can become an investable company in the future if the management of this company turns things around. And there is some reasons to be optimistic about the future of Dubber, some reasons to be positive, but at this point in time, Dubber and their management will have to prove to me that they are turning this company around, in particular when it comes to the cash burn. This company has burned through cash like it's going out of fashion over the past few years. Now, 2 years ago, the investing community didn't care about companies that were burning through cash. They just cared about cash receipts and, in particular, growth in cash receipts. And 2 years ago, in July 2021, the last time this company actually did a capital raising, and I'll talk about that later in the video, the market cap of this company was over $1 billion. And the reason the market loved this company back then was because of their acceleration and their significant growth in cash receipts and revenue. Dubber is a unified call recording and voice intelligence cloud service company. And their services were highly sought after about 2 years ago. And that's why this company had a really good, impressive revenue or cash receipts growth. Dubber was founded in 2011 and listed on the ASX in March 2015, backdoor listing via Crucible Gold. Now, back in September 21, so less than 2 years ago, the market cap of this company was $1.1 billion. That's what a share price at the high of $4.33. Last time I did a video on this company, the market cap of Dubber was 122 million. That was a share price of 40 cents. And right now, the share price of 19.5 cents, and the share price has been fluctuating today on July 25. I am recording this video before closing, so the share price could be probably anywhere between maybe 17 and 19 cents. But at 19.5 cents, the market cap of this company is 60 million. Now, they are doing a capital raising, a fairly big capital raising, I think increasing shares by about $75 million or 75 million. So that means the shares on issue, which were 78 million when they first listed on the ASX, will now be closer to 400 million. So because this company has been burning through a lot of cash since they listed on the ASX, particularly in the last 3 or 4 years, this company has done a few pretty big capital raisings, in particular, a fairly huge capital raising in July 2021. I'll talk about that later in the video. And the ticker code for Dubber is DUB. The main catalyst for me doing this video on Dubber was the release of the company's June quarter results in 2023. Now, before we have a look at the June quarter results, I want to go back in time, have a look at how this company has performed over the past 1 year. And I'm paying particular attention to the increase in cash receipts, but also their spending and their cash burn. And then we'll have a look at the capital raising, because the second catalyst for me doing this video on Dubber was this particular capital raising, the whole reason they went into a trading halt on July the 21st. So let's go back 1 year ago just to see how this company was performing back then. Now, 1 year ago, cash receipts from customers only 6.7 million. Now, if you have a look at the payments for product manufacturing and operating costs and staff costs, both of those parts of the business, spending in those parts of the business, were more than receipts from customers. And because this company was spending a lot of money, this company was operating cash flow negative by 12.7 million in just one quarter. And over the whole year, they're operating cash flow negative by $43.2 million. So this company just loved spending money. Now, at this point in time, they had a lot of cash on hand, $84.4 million of cash. The main reason they had a lot of cash on hand was because they did do a significant capital raising about 1 year ago that increased their cash on hand by about $110 million. So let's have a look at the June quarter results for 2023 and paying particular attention to their spending and their cash burn in operations. The first thing I note when I look at the company's June quarter results for financial year 23, the last quarter of the year, is receipts have grown nicely. In fact, up $3.6 million from last year's June quarter, and for the year to date, up to $36.1 million. But the second thing I notice is this company is still spending a lot of money. However, the increase in spending has slowed down. In fact, it's gone backwards a little bit, because even though product manufacturing operating costs are up $1.7 million, advertising marketing up $100,000, administration costs up $140,000, staff costs down $2.2 million. So overall, their spending is down a little bit because it seems like they have let go some of their stuff. So this is a very important thing to note. So if Dabba can keep on increasing their receipts, keep on increasing their revenue, and keep a lid on their spending, there is a possibility they can reach their goals of becoming cash flow positive in financial year 25. That is one of their goals. However, in this particular quarter, the company was operating cash flow negative by $8.4 million. And for the financial year, operating cash flow negative by $50.8 million. So I'm not even taking into consideration investing and financing activities. So this is just in operations. So this is the main reason why the valuation of this company has significantly dropped over the past 2 years, is because they are burning through lots and lots of cash. And because they are burning through lots and lots of cash, even though they raised $110 million 2 years ago, at the end of this quarter, they only had $32.9 million of cash in hand. And probably another reason why they are raising capital right now is because of the particular cash burn rates they are seeing themselves in. So I want to see, and the market I think wants to see, that this cash burn rate will come down, and they are on that path to becoming cash flow positive in financial year 25. Now, a really interesting thing about Dabba is if I saw their receipts history, particularly from 2019 through to 2021, I would have got excited about this company. And this is the reason why the market got excited, because they saw an acceleration in receipts towards the end of 2020 into 2021. In fact, receipts went from about $1.5 million, in fact, $1.6 million in the June quarter 2020, all the way up to $9.1 million in the September quarter 2021. So that's around the time the valuation reached a peak of about $1.1 billion. Now, since then, receipts have become a little bit more lumpy, but they're still increasing. Now, I would like to see receipts increase at a little bit stronger rate than what we have seen over the past 2 years, in particular because of the cash burn rate. But at least cash receipts are climbing. And the most recent quarter, the last quarter of financial year 23, was a record quarter in terms of cash receipts for this company. And the first quarter, this company has seen cash receipts above $10 million. So if we continue, or Dabba continues to grow their receipts moving forward, and they can maintain a lid on their spending, I think possibly this is a turnaround story in the future. Now, before we have a look at Dabba's most recent capital raising in July 2023, let's have a look at their raising before this. So 2 years ago, on the 27th of July 2021, almost 2 years from when they did the next capital raising, they raised $110 million at a share price of $2.95. So they increased the shares on issue by about 37 million. So again, $110 million worth of shares at a share price of $2.95. So I'm pretty sure there's quite a few institutions who, if they didn't sell out just after this cap raising, pretty upset that they bought Dabba shares at $2.95, particularly because the share price right now is less than 20 cents. A lot of times when a company does announce a capital raising, they will go into a trading halt, and then they will announce the details of capital raising maybe 2 or 3 trading days after they go into a trading halt. And sometimes the AFR will give you an indication of the particulars of the capital raising of that company. So sometimes you don't have to wait that 2 or 3 days. And this is definitely true for Daba because on the 21st, there was an article from Sarah Thompson, Kaniko Asud, and Nara Rapport. I don't know why he needed, or they needed 3 people to write this particular article. There was indications that this capital raising by Daba was for $10.25 million worth of shares at 14 cents a share, which was a 28.2% discount. The other thing they mentioned here is that the lead manager, Unified Capital Partners, they said that the funds raised will be used for working capital and costs associated with the capital raising. So no acquisitions, nothing like that, just working capital. The reason they need funds for working capital is because they are burning through lots of cash. And on July the 25th, Daba confirmed that the RFR was absolutely right. So they are indeed raising $10.25 million worth of shares, including $1.25 million committed to or by Daba directors and management. And the cost of this capital raising is at 14 cents. And they will be raising about, we'll say about 73 to 74 million shares. So again, shares on issue will increase from just over 300 million to just under 400 million. And they also mentioned in this particular announcement from the company that proceeds from the placement after costs will be applied towards general working capital and to strengthen the company's balance sheet. I'm not sure if this company has any debt, probably not much debt. So it's just increase their assets, increase their cash. But if they only raising 10.25 million in this particular cup raising, and they keep burning through $8 million in cash per quarter, they might have to do another cup raising in 1 or 2 quarters. So the most important thing for this company is they really decrease that cash burn by either increasing their cash receipts or decreasing their spending. So I'm really looking forward to see how this company performed in the current quarter, the September quarter. And if we do see signs the cash burn is going down, preferably by the company increasing the cash receipts, then maybe this company is on that path to reaching their financial year 25 goals of becoming cash flow positive. Now let's have a look at the charts for Daba. Going all the way back to 2015, this is the weekly chart. And there was not much interest in this company from when they listed or backdoored onto the ASX all the way through to 2019. So remember during that period, if you go back to the cash receipts history, the cash receipts for this company were flat or going up very slowly through the less than $1 million range into the $1 to $2 million range, stayed in between $1 to $2 million for quite a few quarters. So the market was just wanting to see some signs of growth in receipts. The market saw those signs start of 2019, and that was a breakout for the share price of this company. And then the share price took off until COVID-19 financial panic. The share price fell all the way back down to about 37 cents. But look at the share price after COVID-19 financial panic. Share price increased from about 37 cents to that high of $4.33. It only took about 18 months for the share price to go up that far. Just like it's only taken 18 to 21 months for the share price to fall from $4.33 all the way back down to less than 20 cents. And this is a very typical weekly chart you see, particularly among non-profitable tech companies, sort of like a Matterhorn pattern. Up to the top of the Matterhorn, and once you get to the top, there's nowhere else but to fall down to the bottom. And in fact, who knows how far you've got to fall, because from the top to the bottom of the Matterhorn is a fair distance. And at this point in time, there's no end in sight to how low Daba share price can go if you're just looking at the weekly chart. But you do get a bit of a different picture when you look at the daily chart. So let's have a look at the daily chart right now. There is potential that possibly the shares of this company have moved into a consolidation phase. So let's have a look at that now. The first thing I do when I see that a company share price has been in a long-term downtrend is I look for periods, particularly long periods of consolidation. So that's just the share price going sideways. And there's a reason why that's really important. And you can just see that by Daba's chart over the past year. So this is their daily chart. Now, back in December, there was a nice little rally in Daba's share price. In fact, the share price went from 30 cents to 60 cents. And the reason why that rally in the share price failed in the end was because the share price had been in a downtrend for a long period of time. And there were a lot of shareholders who bought at significant higher share prices who saw this rally in the share price and found the opportunity to sell. So there was an increase in supply, and because there was a rush of shareholders to sell shares in this company, and there wasn't enough demand to buy all that extra supply, this rally failed, and the share price started to drop again. So now we've got new shareholders who bought at higher prices, who now want to get out. And what they're waiting for is another rally in the share price so they can sell their shares. So what happens in a consolidation period? That doesn't happen. So share price goes sideways. There's no rally in the share price. So those shareholders who bought in December on that rally, that false rally, they become bored. This next rally doesn't happen, and eventually they will sell their shares at, say, 20 cents. And what we have is new shareholders who bought at 20 cents. And if the share price consolidates for a long period of time, most of their shareholders will eventually become bored and sell their shares. So the majority of shareholders now would have bought during this consolidation period. And the next time we have a rally, guess what happens? We don't have those old shareholders who bought at higher prices. That's not resistance. They don't flock to sell their shares. And that's why consolidation periods are really important, because it can be the start of new uptrends, because there's very little resistance. Now, for Dubber, I would love to see a consolidation period of longer than 1 year. So all those shareholders who bought between about 2020 and 2022, they can become bored, sell their shares, and on the registry of Dubber, new shareholders have all bought in around 20 cents, so no resistance. So that's the first thing I'll be looking for, a nice consolidation period. The second thing I'll be looking for is some really good financial news from the company. And if the company becomes operating cash flow, free cash flow positive in, say, 1 year from now, say the June quarter 2024, potentially that could be the breakout for this company. And the share price could move into an uptrend. But a lot of things have to happen for that to be true, for that to happen in 2024. First thing we need to see is a consolidation period. Second thing we need to see is this company is turning things around. The cash burn rate is no longer there. Cash receipts are going up. The spending is not increasing at the same rate. And until then, I'm just going to put this onto my watch list and just see if things are turning around for this company. I think we can be patient when it comes to Dubber. So that's all I have for this look at Dubber's, their Appendix 4C for the June quarter 2023.